How do transactions change the balance sheet? In this video, I show how common business events affect the balance sheet without relying on debits and credits. In order for us to be able to interpret the financial statement and to rely on them in decision making, we need to make sure that we understand how common business events and transactions were recorded in the accounting system and how they show up on those financial statements. So, how do we recognize the impact of transactions in the financial statements? If you took accounting as an undergraduate, you're probably thinking, that has something to do with debits and credits. And you're absolutely right. That is the bookkeeping aspect of how we recognize transaction. Now, bookkeeping is just the procedural aspect of accounting. Essentially, bookkeeping is the art of shorthand, the ability to write things down in a very succinct manner, which is really suitable for the accounting system. Now, in these series of videos, we don't really like bookkeeping. We're not really interested in the procedural aspect. Unless you are in the accounting group within an organization, you're not likely to be dealing with debits and credits. So we really need to focus on the conceptual. We need to understand how a transaction, something that happens to a company during a period, ultimately appears on the financial statement in order to be able to interpret those numbers. So let's dig into that. So first of all, what is a transaction? That is a very general term. Transaction is any economic event that occurs during a period and that affects the company's position. Now, it could affect just the balance sheet. It could affect both the balance sheet and the income statement. And we're going to unpack both of those. In this video, I will focus specifically on the transactions that impact the balance sheet. And in the next video, we will talk about the transactions that impact both statements. Transaction does not mean that we have a cash event. We already talked about this in the introductory set of the 4 videos, but our economic events do not always align with cash. Now, we also, on the flip side, have events which are significant to a company. They may be material in the legal sense, they may be important, but they're not technically transactions because they haven't yet occurred. So here the example is something called executory contracts. They do create significant expectations, but they're not going to be recorded in the accounting system because no party has ever done anything. And there's plenty of example of executory contracts that as they occur do not constitute a transaction. When a firm opens a line of credit, so they have the opportunity to borrow money in the future, is it important that they have access to this potential source of funds? Yes. But did a transaction occur? Not yet. If there is a customer order that comes in and it is not coupled with a deposit, so all we have is an exchange of promises. The customer promises to pay us in the future. We promise to deliver product in the future. Again, this could be material event in terms of it indicates something of significance that's going to happen in the future. But as of the moment that this order came in, no party has actually done anything, so it is not an economic transaction. So again, we're going to focus on economic events, and let's just dig a little bit into what is actually inside the accounting system within a firm. So we're going to focus on the result, we're going to focus on the output, the financial statements, but it is important for us to understand where those numbers are coming from and how accounting data is essentially stored inside a organization. We have something called the general ledger of accounts. So this is an accounting book. If you ever hear the terms book value, generally that refers to how is this written in the accounting system in a company. Literally, it used to be a book. Back in the day, you would have a book of accounts, and every single page was designated for a specific account. So you have a page for cash, you have a page for liabilities, such as debt, accounts payable on one page, long-term debt, borrowings on another page, etc. You have a page for each of your income statement accounts as well. You have one page for sales, one page for interest expense, etc. And on those pages, you always see a current running total. So if you open the cash page, it kind of looks like the checking account interface that you might see if you log in. You see the current balance in that specific account. So general ledger used to be a book. Now everything is electronic, but of course the same logic applies. With a couple of keystroke, an accountant can bring up a page of the specific account and how it currently looks like and what the balance is. Each page is an account. Again, that account, it's a little bit of an unfamiliar word if maybe you've never dealt with accounting, but there's no magic to it. Account is just a summary device. It is a distinct item that belongs on the balance sheet or the income statement. So we have a separate account for each of our assets. We have a page for the cash. We have a page for accounts receivable, a page for inventory, etc. We have a separate account for each of our liabilities, each of our equity items. We have a separate account for sales. Potentially, if you have different types of sales, so for example, you have product sales and service sales, you would actually have separate pages for that, a separate page for each expenses, and a separate page for dividends, which we haven't really talked about yet, but we will introduce soon. Now, some of these pages are going to be written in permanent marker, so they get carried over from period to period. Everything that is a balance sheet account, so assets, liabilities, and equity, whatever is the ending balance at the end of one period will be the opening balance at the beginning of the next period. And that makes sense if you think about cash. Whatever is the balance of cash that the company has on December 31st, that will be the opening balance of cash on January 1st. Certainly hope that. Now, some of those pages are instead zeroed out at the end of the period. So all of the income statement accounts, all of the revenues, all of the expenses, we can think of those pages as essentially filled in with a pencil. And then at the end of the period, they are wiped out because we keep track of those things only for a given period. So we reflect our sales as the ones that occurred during a given quarter. So we start on January 1st with 0 sales, nothing happened yet. And then as the first sale occurs, it will appear in the page of the sales account, et cetera, et cetera. And then we get to the end of the quarter. And once everything is done for the quarter, once we use all of the information, it will get wiped out again and we'll get ready for the next quarter. If you dealt with debits and credits, then what you were doing were the journal entries. So what is a journal entry? In addition to the ledger, which like I mentioned, has a page for each account and has a running balance, you have something called the general journal. And it really is a journal. If you think about a diary that you used to maybe have as a teenager, what did you write in the diary? Everything as it occurs. So that's exactly what a company does in a journal. It is a chronological record of all of the events that occur. So we record in the journal transactions and events as they happened. So for example, we record that we made a sale to a customer, we received some cash immediately. And as we recorded in the journal, all of the information gets recorded there and it updates the ledger. So previously, the accountant would write things down in the journal as it occurred, and then they would flip to the appropriate page of the ledger and they would update the cash account and the sales account as well. Now everything is done electronically. So as the accountant records the journal entry as it occurs, it immediately goes into the general journal, but it also updates the ledger at the same time automatically. So again, if you took an undergraduate accounting, you may have seen that this is the way to record a transaction. You have a debit, you have a credit, the debits equal to the credits. One is on the left, one is on the right. We're not really going to do that because it introduces, again, a little bit of, I think, unnecessary complexity in terms of having to remember this just shorthand way of writing the accounting language. And it also doesn't necessarily give us the big picture that we're seeking as maybe managers, as users of the financial statement, in terms of, yes, but what does that mean when we get to the end of the quarter and we look at the financial statements of this company? How did it ultimately impact the financial statements? We're going to do a slightly different way in which we think about every single transaction. Every transaction, we're going to answer some basic questions. So first of all, we're going to ask the questions, which accounts were affected? Second, did each affected account go up or go down? Both are possible. And third, by how much? What is the actual dollar magnitude of the impact? Now, there's a couple of things that we're going to keep in mind. Number one, every transaction has to impact 2 accounts. If I ask you what is the impact of a certain transaction and you say, well, cash went up by $1,000. I say, okay, and what else? And you say nothing. That can't be right. The only way that cash goes up by $1,000, short of Al Capone scenario where things magically happen in a set of books, But in a legitimate organization, the only way that cash goes up $1,000 is if we received $1,000 from a customer, or if we received $1,000 from borrowings from a bank or from investors, or we sold an asset. Something else has to happen. There's never a transaction that impacts just one account. Every transaction is going to impact at least two accounts. So that's rule number one. Rule number two, our balance sheet must always balance. Assets must equal liabilities plus equity after every transaction. And that also means that any change in the assets, of course, mathematically must equal the change in liabilities plus change in equity. Rule number three, we have flexibility in terms of whether the transaction could lead to two increases. That's possible. For example, an asset goes up and an equity account goes up, or whether a transaction leads to one increase and one decrease. For example, an asset is swapped for another asset. So we do have that. Let's introduce the way that we think about transactions and how they impact our financial statements on an example of a very simple hypothetical firm. We're going to think through the very typical transactions that would impact a company such as this, and it will help us to discipline our thinking in terms of how events ultimately impact the financial statements. So here we're going to set up a company called Hartford Hot Sauce. It is a retailer. It sells hot sauce. It is formed by three siblings on October 1st, 2019. And in this video, we're going to introduce 7 transactions that all take place immediately as the company is formed. Again, this is, of course, a simplification, but it serves to illustrate a point. So transaction number 1 is a transaction typical of how every company actually gets formed. Owners invest $50,000 of their own money in return for common stock. We're going to ask a question: what accounts are impacted, in what direction, and by how much? And in this example, what's happening is that on the asset side, the cash is impacted because the business now has $50,000. It goes up, as well as an equity account called common stock, because the 3 siblings now own common shares of the company. So we have the equity account that reflects that we received inflows as a result of creating ownership. Let's check. Do our assets equal to the liabilities? Yes, plus 50,000 on both sides. Let's go to the next transaction. Let's suppose that the owners say that's not enough money for us to start operating. In addition, we're going to do some debt financing. Hartford Hot Sauce borrows $100,000 from a bank. How does that transaction impact the financial statements? Well, we have cash that's coming in, $100,000, and now we have a debt that is created. I could have called this debt. I could have called this bank loan. Again, the language doesn't really matter as long as it is in line with the economic reality. Here, I'm going to call it loan payable. And that liability also goes up by $100,000. Remember our balance sheet equation? Resources equals creditors' claims and owners' claims. And in this situation, our first 2 transactions illustrated that sometimes we're able to fund these resources by raising money from owners, and sometimes we're able to fund these resources by going to creditors and borrowing the money. One thing you might ask, wait a second, but the cash at this point is not 100,000, it's actually 150,000. You're right, but what I'm showing you here is the impact of every single transaction. I am not showing you the ledger. I am not showing you the running total. I am showing you how to think about every transaction and how it ultimately impacts the balance sheet. So this transaction, how does it impact the balance sheet when the firm comes to the end of the quarter and prepare it? It increases the cash by $100,000. Third transaction, now they're going to use up some of this cash. What do they want to do? They want to buy a delivery truck for $90,000, and they're going to pay for it in cash. A truck is an asset. It is a tangible asset. We could just create an asset account called truck, but we're going to put it into the bigger umbrella of where such assets typically get accumulated, called property, plant, and equipment, or PP&E. This transaction reduces our cash by $90,000, but increases another asset by $90,000. So notice there's actually nothing that's happening on the right side of the balance sheet equation. The liabilities are not changing. The equity is not changing. This is an example of a transaction where you have one increase in an asset and one decrease in an asset. So everything is contained just on the asset side. That is not a problem because they are exactly equal in magnitude. our balance sheet is still in balance. We just swapped one for another. The fourth transaction is they say, okay, now we're getting ready to actually build up our inventory that we're going to sell to the customers. So they buy a $30,000 order of inventory on credit. On credit means that they did not pay cash for this inventory. They got it from the supplier, and then they're expecting for the invoice to come that they're going to pay off in the future. So we have inventory, which is an asset that's going to go up by $30,000. And we have another liability called accounts payable that goes up by $30,000. Notice that the accounts payable is in the liabilities section. Every liability is a source of outsiders financing. In this situation, the suppliers gave us $30,000 worth of inventory, and they have allowed us to delay payment for 30, 60, 90 days. So that is a source of financing. It's useful to remember that it's not just the traditional debt, the traditional bonds, but everything that shows up on the liability section is a way to finance our resources by relying on financing from outsiders. Now we get to our fifth transaction. Woohoo! Hartford Hot Sauce receives the first order for $4,000 to be delivered next month. They did not receive any cash from the customer. What do they record? How did this transaction ultimately show up on the balance sheet? So at the moment that this transaction happens, we do not record anything. This is an example of those executory contracts because on October 1st, as we receive the order and as we promise to the customer to deliver this order, at that moment, no party has actually done their job. They haven't given us any money and we haven't done any work. So this is potentially a legal event. This is a contract, maybe that is signed depending on the details, but it is not an economic event, so we do not record it. In contrast, let's say that they receive another order from a different customer, and that second order for $6,000 is paid immediately in full. So the customer says, here's $6,000, please deliver to me inventory in the future. Is the company going to record the second order? Yes, the difference is because someone did do something. The customer gave us $6,000, so we record that cash came in for $6,000. And on the liability side, we have deferred revenue. I'm going to reiterate my prior point. Every liability is a source of financing, not just the traditional debt. So in this situation, the customer is giving you cash and they are waiting for you to do the work. In the meantime, you take this $6,000 and you deploy it in your business. So your customer has financed your operation. Maybe for a little bit, but they did. The main distinction between transaction 5 and transaction 6 is that the customer gave us money. So in both situations, we received an order, but in the situation where that order did not come with a deposit or a payment, we did not record it. And if that order did come with a deposit or a payment, then we do record it as a liability called deferred revenue. So I want to pause here for a second before I go to transaction 7, and I actually want to show an example of how both of these transactions, 5 and 6, would show up in the disclosure in a 10K. I'm going to jump to the SEC filings here. This is the same main landing window that I showed you before for the Edgar system. And I'm going to look at a company called Centrus Energy. I'm going to pull them up. Let's go to their most recent 10K. So first, let's go to the balance sheet. Here's the label, Centrus Energy consolidated balance sheet in millions as of December 31st, 2025. We have here the asset side. I'm going to go to the liability, and here we have deferred revenue and advances from customers, and the amount is $131 million. So this would be stemming from transactions such as transaction 6 that we saw, where the customers gave some deposit, gave some amount of money to Centrus, and expect some work to be done in the future. Can we find examples of the equivalent of transaction 5, where the customers actually put in the order but do not make the payment? Now, I told you that we're not going to be able to find it on the balance sheet. It does not show up because it has not yet been recorded. But is it going to show up in disclosure? It is. The section that I come here, it's actually quite early on page 13. And this talks about the backlog. What is backlog? Backlog is essentially a combination of transactions 5 and transaction 6. So backlog reflects the customer orders that you have not yet done, regardless of whether they came with a prepayment or not. So here, if we look at this disclosure, they actually have quite a sizable backlog. Backlog at the end of the year is $2.9 billion. So almost $3 billion, of which only $100 million roughly came with a customer payment. For a lot of companies, for a lot of industries, backlog is actually an important metric in terms of looking ahead to where the customer demand is going to go. But again, only the piece that's going to come with the prepayment is going to show up on the balance sheet. So that is one of the items that is important for us to look in the 10K in terms of the disclosure about other events that are happening that may not be reflected in the financial statements. Let's go back to Hartford Hot Sauce. Here we have transaction number 7. Hartford Hot Sauce pays $12,000 to an advertising agency for a year of future marketing. That's going to be done in December 2019 through November 2020. How does the company record it? Well, first of all, they parted with cash, minus $12,000. What did they receive in exchange for that cash? An asset called prepaid expense. Could have been called prepaid asset, prepaid marketing, prepaid advertising. This reflects that they now received an asset, which is the right to receive a year of advertising services from this company in the future. So it's not yet showing up on the income statement. Notice that no transactions in this video show up on the income statement yet, because at this point, we haven't started to receive the benefit from this particular cash outlay. It is going to benefit us in the future, but right now it's just sitting as an asset waiting to be utilized in the future. So do we actually have companies that operate in this fashion? Absolutely. Let me show you a couple of examples. This is Ulta, a retailer of beauty products. Let's go to the 10K. We go to the balance sheet and we see that they do have prepaid expenses here. This is an example where it's important for us to pay attention to the units. This balance sheet is not in millions, it is in thousands. So it's 169 million. Let's say I want to know what this prepaid expenses include. I'm going to jump ahead and see if I can get a little bit more detail. I see that they do have prepaid advertising that is included in prepaid expenses, not a very large number. I'm going to continue to jump. Here where I get to a footnote that discusses the breakdown of the prepaid expenses, and we see that they have other items like prepaid maintenance, prepaid supplies, and a relatively big one, cloud computing costs as well. So they prepay to the technology firms for cloud computing. Let's go to example of another company, NRX Pharmaceuticals. Again, let's jump to the word prepaid. On the balance sheet, this is a smaller company. Its total assets are only $12 million. Prepaid expenses is actually a pretty big chunk of those assets. It's about 7%, so more sizable than for Ulta. I would like to understand what these prepaid expenses include. I jump to the discussion of prepaid assets here in note 4, and we see that they have prepaid insurance, which makes sense. So they pay in advance for insurance coverage, prepaid clinical development costs, and others as well. So in terms of what companies prepay for, it's going to differ in terms of whether it is 1% of your total assets or 7% of your total assets. That's also going to differ. It depends on how you have structured your relationship with various vendors, with various providers of service. We're done with video 1 of the 4-video series from transactions to financial statements. Please stay tuned for the next video, which is going to introduce transactions that impact both the balance sheet and the income statement. If you enjoyed the video, then please like, subscribe, share it with your colleagues and friends, and I'll see you in the next one.